Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on everything you need to know at 3 p.m. Eastern Time. First up, bond king Jeffrey Gundlach outlining his top risks for the U.S. economy and warns that the bear market is here to stay. We have the exclusive interview coming up in just a moment.
Plus, the latest Fed minutes showing commitment to keep fighting inflation. A summary repeating that members believe ongoing rate hikes will be necessary.
All right, but let's begin here with the latest check on the markets because the Fed releasing its minutes from the last meeting just about an hour to go, and you can see the impact that it's clearly having on the markets. The Dow flipping back into negative territory for the day. We're looking at losses of just about 132 points as we enter the final hour of trading. The Nasdaq also in negative territory, off just about 0.1%. The S&P off about 0.4%. Of course, the concern here from investors that higher rates might be here to stay for a little bit longer than maybe had initially been anticipating. That, of course, is putting pressure on equities today. Taking a look at the bond market action, the 10-year yield still off just about 3 basis points here, but a bit of movement following the Fed minutes release. Of course, we need to keep a close eye on what the bond market is telling us in terms of the sector action, what we are seeing play out this afternoon. Only 2 sectors holding on to gains. You're looking at materials up just about 0.4%. Consumer discretionary barely holding on to positive territory here, but clearly the biggest laggards coming from real estate and energy sector, Dave, off nearly 1%.
I wasn't really surprised by the minutes. Why were the markets?
I know.
Were you?
They just want any sort of optimism, anything to hang on to. And the fact that we're only off, about 100 points in the Dow, that's not too bad.
Minimal downside there, thank you. Investors have a lot on their mind when it comes to the state of the economy, from inflation to rising interest rates to the national debt. Our Brian Sassi spoke with DoubleLine founder and CEO Jeffrey Gundlach in an exclusive interview and asked him what the biggest risk is to investors over the next few months. Listen to what Mr. Gundlach had to say.
The inflation outlook perhaps darkening from what was kind of pivoted to an investor's psyche, a state of relaxation. I commented on the last Fed meeting after Powell's press conference. Even Powell seemed sort of relaxed. I mean, he actually said something that was really great. I gave him a lot of credit for it. He was asked a few questions, and his answer wasn't, he didn't try to come up with some tortured quasi-answer. He just said, we just can't know that. We don't know that. And we're just going to have to wait and see what happens, which is a truly honest answer. You know, you don't hear that much from public officials. And he seemed to be very confident that the path that had become embedded in consensus economists and ratified, even over-ratified to a certain extent by the Treasury yield curve, that inflation was going to proceed in a way that would be incrementally positive after what last year it was month after month after month of the data being disappointing on the high side. And so that was looking pretty good, and the bond market rallied a lot. I mean, we had the 2-year Treasury, you know, getting pretty low. It was almost going below 4. I think it got to 4.03. And I thought that if the 2-year Treasury could somehow bust through 4%, that would be the moment that the Fed would start to have to take things seriously. The dichotomy between the Fed dot plots and the bond market, which was really sort of telling the Fed to stop. But then they did that weird CPI revision, which is one of the strangest things because it doesn't change anything and yet it changes everything at the same time. You know, we had 6 months in a row where the CPI, the headline CPI, averaged 16 basis points a month. That's not very much. That's only about a 2% inflation rate. So for 6 months it was working. And then they revised that up to 24, which is pretty good. I mean, it's almost double, I mean, not quite. And then the headline was running at like 26 or so, and now it's at 34. And so it's starting to be like, uh-oh, maybe we're not going to get that gentle deceleration and then stopping at that level. And since then, we've had bond yields just go, they're down a little bit today, but as of yesterday, the 2-year Treasury had risen almost 75 basis points since the Fed meeting, which was February 1st. I mean, we're only talking about 12 trading days. Mm-hmm. So just annualize that when you think about it. And then we had the 10-year Treasury march all the way up back towards 4% from 340. these are big rate moves. And so what's ended up happening is a year 2023 that started out as we expected it would be strong, because what a lot of investors or amateur investors don't understand is that markets often change direction at year end, and it's not because of some strange astrological phenomenon. It's because of flows. When you have a big move in markets, either up or down, there tends to be repositioning at the end of the year. So when you have losses everywhere, which of course characterized 2022, the only thing that was up was certain commodities in 2022, you have tax loss selling. And it got really brutal in November, and we predicted it would. Really brutal in November and December. And then all of a sudden, people are all done, and they come back in January, and they are rediverting capital. And you often get a complete reversal. So it's not surprising that the Nasdaq, which was the dog of 2025, turned into the hero of 2022, turned into the hero of 2023. And the Dow Jones, which had been the best one, not really doing very much. In fact, as of today, the Dow Jones Industrials is now negative on the year on a price basis. And so we had a rip-roaring start. We had high yield did well, emerging markets did well, everything but commodities did well. So it's a complete reversal. But now we're getting pretty close to where we started the year on a lot of things.
Should investors start preparing? Should they start to be preparing for a hard economic landing?
We've been preparing at DoubleLine gradualistically, so I always say, don't listen to what I say, look at what I do. And we started de-risking, if you will, at the fourth quarter of 2021. And what I mean by de-risking is increasing treasury exposure, decreasing incrementally. We don't do this all in one day. Credit exposure, and when we get maturities on lower tier credit, we reinvest at a higher tier. So we've been upgrading our portfolio systematically. We entered 2022 with one of our lowest interest rate risks of all time, particularly relative to a passive index. And we ended the year almost at the same interest rate risk as the index, which is an increase for us and some of our funds of about 4 years of interest rate risk, which is called duration. So we started the year at about 2.25 on our biggest fund, and we ended the year at about 6, and we've extended again last week. So we've been upgrading in the treasury market and increasing treasuries, and this is in preparation for, it doesn't matter if it's a soft landing or a hard landing, it doesn't matter. Like, people are always asking me this question, how bad the recession is going to be. It doesn't matter. As long as we're going into a recession, you have to have a certain degree of protection. It won't matter. If it's raining a half an inch an hour, you need an umbrella. If it's raining 2 inches an hour, you still need an umbrella. In either case, you need an umbrella. And so I think that needs to happen. The really interesting question, you asked what the big risks are, is what is it that investors think they know, people who have a lot of experience like me, that we think we know because we've been around, in my case, for 40 years, that might not really be, you think you know it, but it's not true. And I think the number one candidate for that is, over the past 40 years until 2022, interest rates did nothing in a broad brush but fall. They would fall, and then maybe they'd retrace a little bit, with some economic cycle, but then they'd go to new lows. And so everybody's only experienced falling interest rates. So will the markets be the same for the next 20, 30, 40 years as they were for the past 20, 30, 40 years, when the backdrop of falling interest rates is potentially replaced, as it has been so far, with rising interest rates? And I think one of the key questions on that is, what will defaults look like in the non-treasury market, particularly the corporate bond market, the junk bond market? Because the junk bond market has no experience prior to really 1980. So the entire life cycle of the junk bond market has been falling interest rates. So have any junk bonds really ever matured? They either defaulted or got refinanced over and over and over again. Well, what happens when you can't refinance them anymore and you actually have to pay them? That's not a problem for this year and next year in the high yield market, but what about the bank loan market, which is floating rate? Those companies that were paying a spread maybe of 300 basis points over SOFR, the short-term interest rate, they were paying 3%. Well, it's going to be 8 pretty soon, and they get the bill on Fed Day, right? Their coupon goes up within 3 months after Fed Day. And so you're having a massive increase in the costs to these companies. And at the same time, the percentage of bank loans that have been of poor quality, below a certain rating, so that they're the lower tiers, has gone from about 40 to 50% to more like 70 to 75%. So what's going to happen when you get parts of the economy in a recession and the payments from these companies going higher? I think the answer is it will be higher defaults. So another thing that's interesting is there are indices on the same topic. There are indices of lending conditions. There's surveys. Deutsche Bank does one that's pretty helpful, and it's a survey of large lending institutions. Are you easing your standards or tightening your credit standards? And there's a very high correlation between tightening credit standards of a certain magnitude and the default rate on lower tier credits 9 to 12 months later. Well, we're already at that level. The tightening of the surveys has reached the level that has proceeded past significant default cycles. And this one metric indicates that the default rate should be about 8% coming late this year on an annualized basis or early next year. You put that together with, the economy, you put it together with the credit quality being low, and we could see some real interesting painful outcomes that are coming in the next recession, whether it's very severe or not.
I went back and looked at when we talked to you in January 2022 in your LA offices, and you were really
what did I say that was wrong?
Well, no, you were right. You were really one of the first one to, I think, sound the alarm on a growth slowdown and how that might impact stocks, and all of it really turned out to be correct. So now I hear you talk about a potential for a hard landing. What does that mean for the broader stock market?
I think the stock market is in a protracted bear market. It started really in the fourth quarter of 2021. Finally the Nasdaq gave it up, and then finally the high flyers in the Nasdaq. And we've been talking about this, that this was going to happen, because the difference between the S&P 500 and the S&P 495 was pretty remarkable. I mean, the equal weighted S&P did almost nothing, and the actual S&P was going straight up. So that market rolled over, and we've been in sort of a negative mood all that time. But I just think that with interest rates having risen and now they're rising again, it's very negative for the stock market when you have rising interest rates against these valuations, especially real interest rates, which stopped rising back in around October, November, which was the catalyst for the recovery in risk assets in the fourth quarter. But it looks like real interest rates might start rising again.
Within your models, how far do you see rates rising? Do they break 6%?
I don't think so. I think the long end may have peaked. You had the long bond, you get up to around 4.25, the 10-year up to about 4.50. We're not really close to that anymore. The 2-year actually went to a new high yesterday. The high was 4.72 back in October, and it got up to about 4.74 briefly yesterday. Interestingly, it didn't hold there. Today it's back below that level. That's what we call a throwover from a technical basis. And I'm very fond of following throwovers because it means the market is rejecting the push to a newer high. And so I don't think interest rates are going to go there. What's so fascinating is that since the Fed meeting, where the 2-year got to 4.03 the day after the Fed meeting, and now it's risen quite substantially from there. It's pricing in a lot more Fed hikes, and that's because of that weird inflation revision. It's so strange. All they really did is say, you know what, shelter was at 32%, and we're going to move it up to, I don't remember, 35, 36%, and used car prices were at, car prices broadly are 8%, and now that's coming down, and because of that, there's a 100 basis point increase in historical CPI, which is so weird because the history is the history. What if somebody announced tomorrow that they redid the CPI and it's now at 25%? Would people feel different? I mean, the CPI is such a strange construct because it doesn't really apply to real life. Who buys a new car every month? Who buys a used car?
Not me.
Yeah, right? So for most people, I think shelter is more than 32%, probably more than 35%. So it's weird how the market had this violent reaction to something that is an arbitrary construct, but it has priced in about 3 more Fed hikes. The terminal Fed rate yesterday was up at 5.35. I'm skeptical that it's going to get there. I think that in spite of the fact that inflation is going to be reluctant to come down, I just think the shape of the yield curve is the best indicator of the forward economy.
And that is still predicting recession.
Absolutely. When it first inverts, you got to be on watch. If it gets inverted, gets as inverted as we have been now for months and months, and stays there, which of course has happened because we've been there for months and months, that's a pretty high probability indicator of recession. Also, the leading economic indicators are really low, and it's getting worse on a momentum basis. The 3-month annualized is worse than the 12-month. That's really low. The unemployment rate is the last one there that does not say recession, but it's very close to crossing over its 12-month moving average. And when it does, it's one of the best indicators of the front edge of a recession. And we're pretty close. The unemployment rate has not gone up. It's actually hovering down at its lows, but it hasn't really changed much over the last 12 months, so it's getting close to its 12-month moving average. Ultimately, the one that is the slam dunk on recession is if the unemployment rate crosses its 36-month or 3-year moving average. We're pretty far away from that, but that doesn't happen at the front end of recession. It happens to suggest that you're in more of a hard landing type of recession. The Fed themselves, on their dot plot in December, predicted that the unemployment rate was going to end this year at about 4.6, I think they said, up about 100 basis points. That's well above that 200-day, that 12-month moving average. So it's interesting, and historically, when you get more than a 50 basis point rise in the unemployment rate, you've never avoided a recession. So the Fed themselves are, maybe in a backhanded way, maybe they don't even know this fact that I just outlined, they're sort of predicting a recession themselves.
Is the potential black swan event in markets this year, everything tied to the debt ceiling, how that turns out?
I think the debt ceiling is just a straw man. I have so many clients that want to call on the debt ceiling thing, and it happens every time. And they're always, well, what's going to happen? Well, I'll tell you what's going to happen. They're going to do this every other time. They're going to raise it at the last minute. And it's not going to be a big deal. One of these days, though, they're going to have to deal with this deficit. I do feel for the first time in many years that the politicians they're looking out of the corner of their eye anyway, and some of them are saying in public that they understand that this debt sort of is already unpayable in today's purchasing power, but certainly if you keep adding to it, it's unthinkable what might happen. And I thought Mike Pence gave a great interview recently where he took it straight on and said, we have to do something about this. Because when you have this sort of attempt to never have a significant downturn in the economy, Fed to the rescue, zero interest rates, quantitative easing, what you're trying to do is avoid any type of hard landing ever. But that type of activity violates Gunlock's rule of financial physics. And that is that the frequency of problems times the severity of problems equals a constant. So the more you try to reduce the severity of problems, you're going to end up ultimately having a very high severity.
What's the answer?
The answer is you have to raise the age on these entitlements. You have to means base them. I know I'm never going to get Social Security, nor do I care. But there's a lot of people that don't understand that if you just raised the age of eligibility from 65 to 72, for example, you'd pretty much solve the problem. And when FDR set up the Social Security system, life expectancy was kind of below 65. And now it's falling, unfortunately, thanks to fentanyl and suicides, which is probably kind of the same thing in some cases. Sometimes it's just a poisoning. But we're now at about 78. And so why should people don't need to retire at 65. They don't need to get entitlements at 65. They should needs test them. And at least that would stop the balloon from getting blown up bigger to the point where it's going to explode. So that's what you need to do.
That was Jeffrey Gundlach, a DoubleLine founder and CEO. And Dave, you and I were listening obviously very closely to that conversation. A lot of headlines to digest there. One of the things that stuck out to me was obviously some of the comments that he made regarding a recession, saying that DoubleLine is preparing for a hard landing scenario. But he said it simply doesn't matter the severity of a recession, whether it's a hard landing, whether or not it's a soft landing. You need to protect yourself. And I also liked what he started saying about the markets, the equity markets, and what they have been pricing in, or really lack thereof. They have not. They've largely ignored this hard landing scenario up until this point. We're starting to see the sentiment shift a little bit with more and more people paying attention to some of the signals coming out of the bond market with that inversion in the yield curve, and obviously what that typically tends to signal, which is a recession. And Gundlach saying that that is a very reliable indicator still.
Yeah, that you'll need an umbrella no matter what the type of recession is, that we are in a protracted bear market. Couldn't exactly, though Sazi tried a couple times to pin him down on a terminal rate, other than saying that they won't tip 6%, it sounds like he's in the mid-5 somewhere around where the Fed has them pegged. He doesn't understand, like we often talk about, that there's a violent reaction in the markets to something that is relatively arbitrary, and we discuss that quite often here. But yeah, he believes, and many do, that the yield curve is pointing into a recession, and saying that the Fed, in their unemployment prediction, is in effect predicting a recession themselves, and where they see 4.6% unemployment rate by the end of the year. I don't know. I thought that was interesting in comparison to what Mr. Bullard said this morning on an interview. I thought the most interesting thing I heard from him was that we can have a strong labor market and disinflation, that we don't need massive job losses to bring inflation down to their 2% target. That, to me, was the most meaningful thing from James Bullard this morning.
Yes, certainly.
On a side note.
Yeah, certainly a lot to digest there. But really what he was saying in terms of DoubleLine preparing for a hard landing scenario, you always got to be prepared for the worst case scenario at least. All right, well, we also had the readout of the minutes from the last Fed meeting where the central bank raised rates by 25 basis points. Yahoo Finance's Jen Schomburger has a closer look at that. Hey, Jen.
Hey there, Shauna. No sign of a pause in Fed officials' discussions last policy meeting. Instead, officials appear to remain steadfast in their commitment to raising rates and bringing down inflation, which they still see as, quote, unacceptably high. Quote, from the minutes, all participants continue to anticipate that ongoing increases in the target range for the federal funds rate would be appropriate. Participants observed that a restrictive policy stance would need to be maintained until the incoming data provided confidence that inflation was on a sustained downward path to 2%, which would likely take some time. Now, while Fed officials welcomed the drop in inflation over the last quarter of the year, they said they still need substantially more evidence to feel comfortable inflation is coming down sustainably. The minutes, which are released with a 3-week lag and thus a bit stale here, came before the jump in Treasury yields, which showed a number of Fed officials were concerned at the time that financial conditions had eased and could require more rate hikes than thought. Quote, a number of participants observed that financial conditions had eased in recent months, which some noted could necessitate a tighter stance of monetary policy. Participants noted that it was important that overall financial conditions be consistent with the degree of policy restraint that the committee is putting in place in order to bring inflation back to that 2% goal. Now, the minutes also showed that a few participants favored a 50 basis point rate hike instead of the 25 basis points to try to get to that peak rate on the Fed funds rate as fast as possible, and thus a more restrictive stance. Of course, last week we learned who those Fed officials were, both Cleveland Fed President Loretta Mester and St. Louis Fed President James Bullard. Now, officials see risks to the economy to the downside, noting that it really wouldn't take much to tip the economy into recession. Participants warned that any lengthy negotiations over raising the debt ceiling would pose, quote, significant risks to the broader financial system and the economy. Guys?
All right, Jen, thanks so much. And given all that, we saw the Dow only off 109 points, Nasdaq back in positive territory. It's hard to wrap your head around the exact moves of the markets here following the latest data that we're getting here from the Fed. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, the Biden administration isn't stepping in to help Apple fend off a potential Apple Watch import ban. We will tell you what it means for those of you who may want to buy one. Then the push for a 4-day work week. We will debate the pros and cons behind that growing movement. And a slew of companies releasing earnings today. NVIDIA, eBay, Etsy, Bumble, and Lucid all reporting after the bell. We'll dive deep into those results in the next hour. Don't go anywhere.
Everyone, after the call coming at you, and guess what? The next company that we're going to be listening close to is NVIDIA. Julie, what are you going to be watching for?
I mean, they already are one of the original AI companies. You know they're going to talk about that buzzword somewhere along the way.
I'm going to be watching for those graphics processing units, the GPUs. Ladies and gents, boys and girls, tune in to After the Call. We break down all things NVIDIA.
Let's get a quick check of the markets on this hump day as investors digest comments from the Fed's last meeting. You can see not digesting them so well, but really not all that bad. You can see the Dow dropping 129 points and the S&P has fallen just barely into negative territory, 11 points. And the Nasdaq somehow digesting what they heard and just barely in the positive. Always interesting to see how the markets digest the Fed minutes after yesterday, what was the worst day thus far of 2023 as far as the markets go. For more Fed reaction, we turn to Alan Blinder, former vice chair of the Fed and professor of economics and public affairs at Princeton. Always great to see you, sir. Alan is the author of A Monetary and Fiscal History of the United States, 1961 to 2021. So one of my favorite pieces of wisdom comes from John Wooden. Surround yourself with smart people who will argue with you. And that's what you wanted to see in the Fed minutes from Jerome Powell. Did you see that?
Only a little, and in the opposite direction that I had hoped for in my last Wall Street Journal column. I had thought there'd be a little more dovish sentiment at that meeting. Remember, that was before those annoying changes in seasonals changed the inflation profile quite dramatically. I mean, it's a wonkish point, but unfortunately it happened. Doesn't happen often, but it did happen then, which sort of tilted things more in a hawkish direction The last FOMC meeting was before that, and I thought there might be a bit more dovish sentiment. Instead, the few, I don't want to call them dissenters because they didn't register formal dissents, but the few people, according to the minutes, that disagreed with the majority wanted 50 basis points, not 25.
So, Alan, what does that mean then for the U.S. economy, for the markets here going forward, if we have a hawkish Fed and maybe more hawkish than Mehdi had anticipated in terms of the conversations that were taking place at the last meeting?
Yeah, well, I think you've seen it already, actually, in the markets because they reacted to the data before the minutes, is a markup of the expected peak in the Fed funds rate. I've marked mine up a little. I leaned dovish, and I thought they might actually, before the recent data changes, I thought they might be thinking about stopping pretty soon. Now it doesn't look that way at all. They're not going to stop at 5.
They'll go how high? And what is the Fed to you misreading?
Well, the question is the time profile of inflation. They want to see inflation going down. It is going down. Prior to the data revisions, it was going down really fast. And that's what I reacted to and some of the dovish sentiment reacted to. After the data revisions, it's going down still, but much more slowly. And the magic number, as we all know, is 2, which on the CPI is really more like 2.5, by the way, another wonkish point. But we're not there yet. And if we go there slowly, that means rather than rapidly, that means the Fed's going to stick to its interest rate increasing policies for longer. And that's the way it now looks, mostly because of the data revisions and just a tiny bit because of the hawkish tone in the minutes. So I'm not surprised there wasn't much stock market reaction to the minutes. It wasn't that newsworthy.
Yeah, Alan, we've long been debating now for several months a hard landing versus soft landing scenario. And then we had this new term come up in terms of a no landing scenario, which has gained some traction over the last week or so. I'm curious to get your thoughts on this no landing scenario and how the Fed would potentially look at that.
Yeah, well, it's anybody's guess what's going to happen. The latter part of your question I find easier to answer. I think there's still a lot of sentiment on the Fed, not everybody, but a lot of sentiment favoring a soft landing if they can manage one, which means when push comes to shove, and we're not there yet, probably taking a little bit of a risk that inflation won't go all the way to 2 by the Fed's preferred measure. A little bit of a risk, but not a gigantic risk. Whereas the hard landing scenario would be, we're not taking any risk. We're heading down to 2 no matter what. I don't see a lot of sentiment for that on the FOMC. The no, what's come to recently be called the no landing scenario would be wonderful, like I wish for it every night. But I don't think it's very likely that we're going to get there without at least a bump of the putative aircraft.
Professor Alan Blinder, always great to see you. Appreciate all of that analysis, sir. Thanks so much. All right, coming up, Target's big investment. The retailer looking to put some big money into its e-commerce business. We'll tell you just how much next.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Target, Warner Brothers Discovery, and Wingstop. Kicking it off with Target, the big box retailer saying that it is investing more in its e-commerce business to speed up delivery time. So the retail giant spending $100 million to build a larger network of supply chain hubs. They're calling them sortation centers here after testing the concept in a couple of cities. Now it currently has 9 of these centers with plans to open more and also create hundreds of jobs over the next several years. Now the centers could potentially help Target boost its online sales, which have slowed in recent quarters, by ensuring faster delivery for its customers. E-commerce sales increased by less than 1% in its third quarter. That's the most recent results. We're getting earnings from Target next week, but that's actually down from 29% growth the prior year. Allie, the competition is very stiff in the retail sector overall. Obviously, among the big box retailers, they're going up in many situations against Walmart, against Amazon, which you could, I think, make a pretty strong argument that they have much shorter delivery times.
Right, and at the end of the day, what do consumers want? They want to get their delivery as fast as possible, and they don't want to pay high delivery fees. So that seems to be what this sortation center project is going to focus on. And I mean, let's admit it, Amazon is a behemoth in this space, so why not try and beat them at their own game? Of course, Target has been going through a bit of a rough patch. They cut their outlook for the holiday quarter. They said they're looking to slash $3 billion worth of costs over the next 3 years. We'll see what those earnings results, what story that tells next week. But I think what's interesting is I've noticed on TikTok and social media, people have branded Target as this luxury experience. You go in, you take your Starbucks.
Do tell.
Yes, I've noticed that trend.
I like
on social media.
When I go to Target, it's nice.
That's what people say. You go in for one thing, you leave with 50, and I wonder.
That I know, but the luxurious part of that.
Oh yeah, if you see
They have
TikTok
higher end things than I think some of its competitors. I would definitely.
Target. I mean,
Target.
come on. So I wonder if there's a play there for Target moving forward, maybe partnering with some TikTok or social media influencers. I don't know.
You know, I don't spend a lot of time on TikTok.
I could be the
so
CMO.
I'm always eager to learn. I think it's interesting. E-commerce sales, we learned a lot with Walmart.
Yeah.
You know, they were a 12% increase there at Walmart, far exceeding Sam's store sales. Sam's Club up 21% on e-commerce. And something Sean and I talked about earlier, Allie, which is surprising, is you talk about their competitors, Walmart and Amazon. Well, they do subscription services, and Target has stayed out of that. Well, they did have one. It started in 2014, and they canceled it in 2020. That's the game that you can't help but wonder if they want a mulligan there and to get back in. That's where everyone's going, is to a subscription service with free shipping, and some deals.
And then you also get that reoccurring revenue. It's so much easier for shoppers. And given that tough competitive landscape, you would think, I think Target should definitely do that. That would be my next.
Seems to be limited downside in getting in that game.
Yeah, potential value play there, potentially too. Well, from TGT to WBD, my triple play is Warner Brothers Discovery. The media giant is set to report quarterly earnings results after the bell on Thursday and will likely face pressure from its ad business, with double-digit declines expected on the TV ad side. Management has said it's targeting $3.5 billion in cost-cutting synergies over the next 2 years, and we've seen that play out with multiple canceled projects, layoffs, and other downsizing initiatives. But I think we're still going to see a weak quarter here, guys, especially with that uncertain advertising environment moving forward. Just the fact that we have so much competition, so many cord cutters out there. But I will say that shares are up today ahead of those earnings results tomorrow, about 4%.
And way up to start the year, which is one of the enigmas of this year. I mean, almost 60% on the year. Some sports looking forward for WBD. They are in the RSN Regional Sports Network game because of that merger with AT&T. Looks like they are preparing to exit that, if you listen to people in the industry. On the flip side, they saw their strongest All-Star weekend ever when it comes to the NBA. 23 new advertisers came aboard. Now, this is a Q1 story, but it leads me to believe they see those numbers and want to stay with the NBA. It is in their core with TNT and Turner and TBS. I just would be stunned if they don't stay in the NBA game. My play is Wingstop, Wing, a trending ticker on Yahoo Finance today after reporting strong Q4 earnings. Revenue increased 45%. Same-store sales up more than 3.4%, and digital sales up a staggering 63%. The company reaffirmed its 3 to 5 year outlook of mid-single-digit domestic same-store sales growth. Wingstop opened 228 new restaurants in 22, including 8 in New York City, and they plan to top that in 2023 to continue opening. Their CEO, Michael Skipworth, saying in a release, the combination of strong top-line growth and meaningful deflation in our business has continued to strengthen our brand partners, unit economics, and position the brand for continued long-term growth. That deflation he's talking about is significant. Chicken wing prices are pre-pandemic levels after spiking. You see the shares spiking as well, up 8%. But that's not where we're taking the conversation. We're doing a little ad lib today. What is your favorite ticker symbol? Mine is Wing, and that's why I bring it up. W-I-N-G. You can't beat that, so I win this already. TAP is number 2, Molson Coors. I love that when they reported yesterday.
Okay, those are 2 good ones. I have 2 as well. So Woof for
I was
Petco
gonna
because
say that
I think
one.
it's very cute. Sorry about that. Okay, and then also Car for Avis because I think it makes a lot of sense. Maybe it would take you a little bit by surprise, but the car rental company
Car, solid.
with the ticker Car.
Okay.
I like it.
I also, this is an off the beaten path one, but I love Amazon, AMZN. It just like flows off the tongue. Like, I don't know, even when I first started covering stocks, I was like, Amazon, I can picture that. AMZN, it sounds how it looks. You know, I just like that ticker symbol. It's kind of random.
I'll give you a third that I think you'd like. They report today after the bell, Cake.
Oh yeah,
That is Cheesecake Factory.
That was a good one too. I was trying to go like non-traditional, but
We should do ticker symbols we hate.
I'm gonna go home and like study this.
There's
tonight.
a lot. Yeah, I was gonna say Amazon's makes a heck of a
Thanks
lot
for
more
playing,
sense
guys.
than Apple, which is
AAPL.
That threw me off, yes.
Threw me off for a long time. All right, well, coming up next, it's all about how you diversify your portfolio. Our next guest breaking down some of the best ETFs for fighting inflation. Stick with us.
Today's release from the Federal Reserve shows that officials are still working to strike a balance between doing too much or too little in their fight against inflation. But the consensus is there is still much more work to be done. So how should you allocate your portfolio in this kind of environment? To discuss, we're joined by ETF think tank Director of Research, Cynthia Murphy, for this week's ETF report brought to you by Invesco QQQ. Nice to have you in studio from Chicago. How do investors digest what they're hearing, what they're seeing from the Fed, and invest in that moving forward?
You know, it's interesting because we've been talking to a lot of your macro analysts, your advisors who are dealing with people trying to make these decisions. And I think that what we've seen is there's been a reluctance to accept that things really are tough. And today I was, reading some stuff and I saw this phrase that really resonated, which is this idea that maybe the market is finally done fighting the Fed. And so maybe this is the moment where we're like, you know what, this data is really not looking good. This inflation is really sticky. And so you're talking to these advisors and you're reading researches and you're reading surveys, and it's all about, I don't know what to do about inflation. I need to diversify. And the interesting thing is there's been a lot of products that launched in the ETF market in the last 12 months to 18 months that tackle exactly that, like inflation focus, different ways to approach and diversify that. But there's still a consensus that investors remain underallocated to these alternative return streams. So I've heard people say you got to be at least 10, 20% of your portfolio has to be in these types of investments that are outside of your traditional equity and bond, and really diversifying that exposure, because diversification is the only thing that's going to save you right now, and really try to focus on things that do well in inflationary environments. So it's been really like a shift in that, that acceptance that, okay, maybe the rally we started off, we got a little excited, but it doesn't look like it's going to have a lot of legs.
So Cynthia, for those people who are looking to diversify, to allocate some of that in preparation of this, what are the best funds to do that with?
So if you're looking specifically on inflation-specific ETFs, there's like at least 15 of them. They're all very different. So you got to make sure you know what you're looking for. Some are exclusively commodities futures portfolios. Some are companies that benefit from inflationary environments, so like mining companies, real estate names, that kind of stuff. Some mix some. Some have commodity futures, some companies, a little bit of crypto, which did well this year. So, like a fund like iWin, it has done better than most this year. So you really got to look and see, make sure how that is going to interact with everything else in your portfolio. So there's a lot of alternatives there. I mean, we've seen also from an alternatives perspective, a demand for your hedge fund replication type of return stream, because it's also kind of different, uncorrelated to everything else. And it's been an interesting space.
Do you have some specifics on the hedge fund replication ETFs, and what is the story that they're telling in terms of the inflows?
So what's interesting is there's a few interesting tickers there. HFND is one. QAI is an older fund in that space, and they are called your multi-strategy ETF. What's interesting about that is that, so they're looking at the entire hedge fund space, global macro, long short, all of them. They combine all this stuff, and then they invest to replicate this overarching view of hedge funds. And what you see in these portfolios is hedge funds are really defensive. I was talking yesterday to a former hedge fund guy, and he's like, I haven't seen hedge funds this conservative in 25 to 30 years. So like these portfolios like HFND is 20% in cash right now. I mean, that's a huge cash allocation. And it has a lot of commodities in there and real estate. It's defense, defense, defense. So it's really interesting that hedge fund managers tend to be the most expert, most professional investors out there, and they are all in defense. Very low risk, very low leverage. And these ETFs are positioned that way too. So it's kind of an interesting statement about the state of affairs.
What's coming down the road,
Yes.
perhaps, at least what they believe. Cynthia Murphy,
Yes.
great to have you here in studio. Very much
Thank you
appreciate
so much.
seeing you.
Thanks.
Apologies, have the phone there. All right, coming up, a ban on importing Apple Watches in the U.S. may be approaching. We'll tell you why and if it's likely to succeed ahead.
President Biden has said that he will not veto a December patent ruling by the International Trade Commission that could lead to an import ban on Apple Watches here in the U.S. Yahoo Finance's Dan Halley has been tracking that story for us. And Dan, what can you tell us just in terms of why we didn't see the veto and the implications of this, what this could mean for Apple here going forward?
Yeah, a veto is basically, it just doesn't happen usually. It's only happened once, and it was for Apple, at least recently, with regards to the iPad. But this has to do with the EKG sensor. And essentially what the ITC is saying is that Apple infringes on the patent for this company, AliveCore. But there's also the Patent Trial and Appeal Board that says that those patents aren't even valid. So there's this ongoing issue. Apple says it's going to appeal to take this to an appeal. AliveCore is still hoping to ensure that those patents stay intact. But we're not going to see Apple Watches stopped being imported into the U.S. It'll likely just be, if anything happens, that Apple has to pay some kind of royalty potentially to AliveCore.
Talk about licensing deals. So from EKG to the diabetes game, how is Apple getting in on that?
Yeah, this is according to Bloomberg, Mark Gurman, who probably lives inside the walls of Tim Cook's house. Essentially, this is a no-prick glucose monitor. And so you would be able to monitor for diabetes or pre-diabetes, things along those lines from your watch. But according to the report, this is still a large device. It started at like roughly table size, then it's something down to your bicep, and they still have to miniaturize it, but they've shown proof of concept at this point. So don't expect it to be coming this year or next year. It could still be something that's coming down the line. And look, this is something that companies have been trying forever. Google wanted to put in contacts that would measure blood glucose levels, but they abandoned the effort because it was just too much, right? So this is something that Apple's been working on, and it goes toward their kind of vision of being more of a health-centric company in addition to your everyday tech. You have female health monitoring. You have the ability to monitor your heart rate, the ability to check atrial fib, sleep tracking. You can send all that information to your doctor if you want. So this is just part of their move to go more into health. It would be massive if they got this off the ground really and into stores.
It certainly would be a massive, massive milestone. All right, Dan Halley, thanks so much. Well, coming up, we are counting down to the closing bell on Wall Street, looking at losses across the board. And now, actually, with the Nasdaq just slipping back into positive territory, the Dow, though, off 105. We'll be right back.
All right, just a couple of minutes away from the closing bell. Let's bring in Yahoo Finance's Jared Blickery to break down the market action as they digest the Fed minutes.
Yes, and we're sitting better than we were 24 hours ago, and Nasdaq has just climbed back to zero. Let's put a two-day chart so we can see still down 2.5% after yesterday's losses, factoring in those as well. Dow and S&P 500 down about 0.25%. Nothing to write home about. Dollar is stronger today. Longer-term yields backing off a bit, and that front part of the curve that's really tracking the immediacy of the Fed, that's holding right near highs. So no break from the Fed today that I see. Materials, consumer discretionary, and communication services, those are the only sectors in the green here. Real estate, the worst performer here, that is down about, or real estate down about 1%. And then looking inside the Nasdaq 100 here, Amazon and Tesla, those are standouts, each up more than 1%. Intuit, the software company, up more than 2%. PanW, now I haven't talked about this in a while, that's Palo Alto Networks, that's up about 12%. Other than that, not seeing a whole lot of standouts, and I think that's probably what a lot of investors will accept and be happy about, since it's not those outsized losses that we were talking about yesterday. ARC components, ARC, one of the worst losers yesterday, that is in the green today for 2%. Bitcoin, that is a BITO ETF down there. That's what that is representing. That's down about 3%. Just taking a look at meme stocks here, I didn't see anything that was catching my eye. In the sea of red yesterday, AMC was standing out. It's up about 2% today. Hostess Brands, no news on this one. Twinkie Maker, that's up about 8% today. And just for fun, I'm going to put a one-year chart on there, and let's see if that pulls up in time for the closing bell. Yes, we go. Here we go.
All right, that does it for today's trading action. A bit of a mixed result here with the Nasdaq just barely holding on to gains, up about 0.1%. S&P closing in negative territory, as well as the Dow. The Dow well off its lows of the day, but still closing off about 83 points. Let's tick through some of the top stories, some of the big movers of the day, and we want to get to Meta. Shares closing off just about 0.6%. The Washington Post are reporting that the company could potentially be preparing for a second round of layoffs. Now, this comes just months after Meta cut about 11,000 jobs, 13% of its workforce back in November. And Dave, when you take into account what Meta is potentially doing here, they're pushing managers reportedly into lower level roles, also considering more traditional cuts, slashing some projects and jobs. And it really all goes back to what we heard from CEO Mark Zuckerberg in that last earnings call in the release when he said it's the year of efficiency. And it looks like at least he's following through on that.
Yeah, he said specifically this is the beginning of our focus on efficiency and not the end. But he had said prior, when he made those initial layoffs, the ones you just referenced, that they hoped that that would be the end of it. Clearly, it is just the beginning. But they are giving some significant pushback on this Washington Post headline. Their comms director on Twitter pointing out Meta plans to cut thousands of jobs after the CEO predicted no more layoffs. Here is the comms director, Andy Stone. You probably can't read that, but the Washington Post got this wrong. With all due respect, how do you run a story with a headline that's contradicted by the reporting in the very same story as well as previous reporting? Now, Andy Stone didn't exactly say there will be no layoffs and there will be no, as the Washington Post defined it, deflating of the hierarchy, which essentially pressing down on all those job titles, leveling the playing field a little bit. They weren't clearly saying there will be no layoffs at Meta. That clearly is going to happen. Not a significant, they want to find some way to quibble with the exact wording of how the Post reported it. But look, it's just the beginning of the story for the entire tech industry. This is just round two for them. It's going to continue throughout the year.
Yeah, and we've already seen a number of companies begin to announce more rounds of layoffs. Meta is far from the only one within that sector. You have Twilio, Wayfair, Crypto.com, Rivian, Vimeo, Groupon, DocuSign, just some of the names here that have already announced their second round of cuts this year. So we talk about the fact that we are starting to see layoffs, corporate layoffs creep back in. For the most part, While there certainly are a couple of one-off stories here and there, many of the layoffs have been centralized, have really been within the tech sector, within the information technology sector here.
Yeah.
What we need to watch, though, is whether or not that starts to spread. At least for now, it seems like it's staying within that industry.
It does. I mean, McKinsey did announce, I think, 2,000, one of the biggest cuts they've ever seen. You had a few others. KPMG, I think the first of the big four accounting firms, going to lay off about 2%. But for the most part, this is a tech story. I can't help but wonder, ZipRecruiter had a very tough report today. Their stock has fallen about 24%. So I can't help but wonder, we don't want anyone to lose their jobs. But if ZipRecruiter could add some names to that list. For the most part, though, when you look at the other side of the economy, it was just yesterday we talked about Home Depot investing $1 billion in wage increases, Walmart raising their minimum wage from $12 to $14 and their average pay to $17.50. So it's still really an economy of two completely different stories at this point, as the labor market remains hot and extraordinarily tight and shows really no sign of letting up outside of tech.
Which, of course, then could potentially be good for those who are unfortunately laid off here, hopefully able to find a new job pretty quickly. But it's also important to point out a lot of these companies that are laying off employees are ones that scaled very, very quickly during the pandemic. So the number of layoffs still do pale in comparison to the number of hires that they have made over the last 3 years.
Yeah, they're still well above pre-pandemic employment levels. Let's talk more about this with Ross Macefield, Baird investment strategy analyst. Good to see you, Ross. What do you make of these continued layoffs, the report at the Washington Post, and what does it tell you about what is coming?
Yeah, I think you all said it right. Whether it's, a West Coast recession or a rich recession, it's clearly focused in kind of the information and, kind of white collar sectors. The story in basically every other part of the economy is, as you mentioned, companies either investing in kind of hoarding labor, keeping labor, or outright sectors and industries that can't hire enough people, manufacturing, construction. There's a shortage that is causing them to really have problems and kind of, choke points in the supply chain. So, it is a tale of two markets. And I guess the story for the Fed and for the U.S. economy is that the information sector is such a small percentage of overall employment, even though it's a big percentage of the stock market, so it gets this outsized weight in our head. The bigger story is still labor market tightness and what that means for the Fed, as we go forward in the year.
Well, Ross, what do you think it means for the Fed going forward for the remainder of the year? We just got the Fed minutes released earlier this afternoon. The takeaway here, the signaling at least higher rates potentially for longer. What was your read on that and the implications there for equities?
Look, I mean, at this point, the Fed has been fairly consistent. It's the market that has come entirely around to their view, which is higher for longer, terminal rate above 5%, all the way through to the end of 2023, and then kind of take a look around. So we might, get a change in tune when they have their March meeting, their updated Summer of Economic projections. But at this point, it's basically been the market repricing to meet the Fed, where they already stood. And so what does it mean? Well, the Fed is laser focused on employment. They're talking about, core services, X housing. That's just code for wages. And right now they see a labor market that's still deeply imbalanced and still short, enough workers to cause upward pressure on wages and therefore price inflation. So, nothing meaningful that would change how they're feeling about things.
Should we take those Fed minutes with a grain of salt, given how much has changed in the data since that Fed meeting?
Yeah, absolutely. I mean, it's been a February for the books so far. But I mean, I think if anything, again, all that happened in February was the market came around to what the Fed had already been saying. So if there's, risk to one side or the other, I think, unfortunately or not, it's risk to the upside from the Fed's, earlier projections at this point. The labor market has not really yet cracked. And the disinflationary process has started, but CPI and PPI were hotter than hoped for. So I think if anything, you're starting to see some Fed speak about 50 basis points or maybe an extra 25 basis point hike in the summer. So if anything, there's risk to the upside when they release their projections in March after all of this February data.
Ross, do you think we're headed for a 50 at the next meeting?
It's tough to say. Probably not at the next meeting. I think the market is still pricing, last time I saw it was about an 80-20 for a 25. I think the Fed doesn't want to react too much to one report. I mean, if there's a long-term story, about this economic data. It's that 1 month of data can be noisy. There can be seasonal adjustments. There can be big revisions after the fact. And if the Fed hikes too much on this one report that say then gets revised down, you risk stepping into over tightening and all the things that come along with that. So I think they'll stick to 25 here, but I think they'll be a lot more open to the idea of 50 or another 25 down the road, maybe not getting to that terminal Fed funds rate until sometime over the summer. And then, of course, the big part of their projections, which is higher for longer, holding that, steady through the end of the year, perhaps into 2024.
Yeah, it certainly looks like that's what they're going to have to do, get anywhere near 2%. Ross Mayfield, thanks so much. Appreciate that. All right, coming up, an earnings avalanche, keeping investors busy. After the bell, we'll break down all the numbers for you next.
Let's take a look at shares of Etsy. Look at that, jumping just about 6% following its most recent earnings results. Revenue coming in better than expected, $807.2 million. That beat the street's estimates of $753.7 million. That $807 million revenue was a record, up 12.6% year over year. Gross merchandise sales also beating the street's expectations, coming in at $4 billion. That, though, was down by 4% from a year over year basis. Some commentary here from Etsy executives in this earnings release, really taking a victory lap in terms of the performance of what we have seen here from Etsy. Their chief financial officer saying that we are now nearly 3 times the size we were pre-pandemic, and we've been careful about how we have grown our cost basis to catch up with the size of the business visible in our sustained profitable growth and strong free cash flow. Again, shares here jumping after hours. We were up just about 8% shortly after the release, now up about 6% here. But Dave, another look at the consumer, and clearly consumers still willing to spend, at least when it comes to Etsy.
It's a very surprising look at the consumer, given what we saw. There's not any direct competitor to compare, but when you talk about the two biggest consumer-facing names this week were, of course, Walmart and Home Depot, and what we showed is a cautious consumer trading down, higher income shoppers shopping at Walmart trading down. You saw Home Depot talk about visits down dramatically. So I think it is a surprising look, actually bucks the trend, largely speaking, from what we've seen. It'll be interesting to see something relatively comparable when we get eBay here in just a couple of minutes. Are they seeing a consumer that is still eager to spend? Because generally speaking, the consumer is spending on experiences and travel away from goods like Etsy, but it also shows their ability to shake off that report from Citron that highlighted the amount of counterfeit goods on Etsy. Clearly not much of an issue. Could be, I guess, moving forward for Q1, but the analysts we spoke with yesterday largely shook that off entirely. As you can see, shares continue to rise off of this Q4 earnings report, up nearly 7%.
And it certainly will be interesting to hear if we do get any commentary on that call about the short seller Citron research and what they had published here just in the last couple of weeks. All right, let's take a look at eBay because those results are also out. Adjusted EPS coming in at $1.07, revenue coming in at $2.5 billion. You're looking at gains of just about 1.5%. Gross merchandise volume coming in at $18.2 billion. That beat the street's estimates of $17.97 billion. Also, the guidance here from the company for the current quarter for Q1, that revenue guidance also beating the street's expectations here. We know eBay has been trying to reduce its expenses to align better with some of the declining sales that we have seen since a pandemic era boom. eBay did announce that it was going to cut 500 jobs, 4% of its workforce earlier this month. So some cost-cutting measures going on at eBay. But again, these results at least pushing the stock to the upside with shares up just about 2%.
So two consumer-facing names. Tell us a little bit about spending continuing. Meanwhile, shares of Bumble. Let's see what they're doing after hours after they report Q4 up about 5%. Do we see the earnings beat continue? Ali Canal here with the answer.
Yeah, so actually Bumble reporting pretty strong results here, and this is a good thing considering what we saw from Match Group. Match Group missing on that revenue, which sent shares to the downside, but now we have Bumble shares moving higher today, up about 5%. Revenue coming in at $241.6 million versus estimates of $235.83 million. There was an adjusted loss per share of 85 cents. So that is something that was also a slight miss there. But a key metric here, total paying users, that includes both the Bumble side along with the Badoo app and others. The Q4 estimate was 3.4 million. The actual results came in at 3.41 million, so roughly in line with those estimates there. And if we break that down even further, 2.2 million on the Bumble side, 1.2 million on the Badoo app and other paying user side. And then finally, if we take a look at average revenue per user, that came in at $23.01 versus estimate of $22.54. So another beat there. And for the forecast for Q1 2023, the company says it expects revenue between $238 million to $243 million. The estimate was $241.4 million. So right in the middle there, that seems to be encouraging to investors. We did hear from founder and CEO Whitney Wolfe Herd in the press release. She wrote, quote, "We achieved strong results in 2022 by advancing our powerful products, technology, and mission to create kind connections. By delivering unique and engaging product experience built upon a foundation of trust and safety, our team is realizing the tremendous potential of our brand." So some really big words there. It'll be interesting to see what they say on the earnings call when it comes to the future of this company and really online dating as a whole.
Yeah, it certainly will be. Some of those growth numbers there that you did mention, the paying users, that was up 14% year over year when it comes to Bumble here, 3.41 million overall. That was up when it comes to the Bumble app specifically. The growth that they saw there was 35% growth year over year. Certainly something significant here for the company expanding and what has been a very, very uncertain time for the economy. The revenue growth, Ali, that you mentioned was up 16% on a year-over-year basis. Lots of questions, though, about whether or not some of these types of companies, consumer-facing companies, ones that are more discretionary spending, whether or not they are going to be able to hold up okay during the potential recession. That, of course, is up for debate. But the street extremely happy with what we are seeing from these results, with the stock up just about 7.5%. All right, Ali Canal, thanks so much for breaking that down. Coming up, Lucid Group shares are moving after the company released its results. Shares off just about 8%. We'll be right back.
All right, shares of Lucid trading down more than 9% after reporting fourth quarter earnings. Let's take a deep dive into the company's latest financial report with Jamie Perez, RF Lafferty & Co. Senior Research Analyst. Nice to see you, sir. So needless to say, disappointing numbers. What jumps out to you?
Well, the deliveries were a little weak. They produced about 7,200 vehicles this year, but they delivered 4,400. So it's about 60% of the cars they produced, they deliver. So that's a little weak. And, they missed revenues by 16 million. So we can see a little bit of a change of mix from the high end to more modest cars because, Lucid is a high end luxury EV. But I'm not too concerned about this quarter. I'm really concerned about the production number for 2023, which is at between 10,000 and 14,000.
Yeah, Jamie, about that production number, what were you hoping to see? And in terms of the issues that they are having with delivering their vehicles, sure. Certainly Lucid has been struggling with bottlenecks, quality control issues. Where does that stand from your checks?
Right. Well, last year they estimated about 20,000 vehicles, so they cut their production guidance last year. So this year it's a little bit significantly trimmed down. You expected in the 20,000 run rate, but I think what they're trying to do is maybe achieve a more doable number given supply constraints. So guidance between 10,000 and 14,000, it's pretty good. Not great like somewhere like Tesla, which is the benchmark, but for a startup EV producing within the last couple of quarters, it's pretty good. But we expect a little bit more.
That 23 number does not include the 100,000 cars that will be a part of that Saudi Arabia agreement. Sure. Where do you feel that public investment fund situation is headed? Are we taking that company private? I think they own what, 55, 60% right now. Where do you believe that's headed?
Well, I think I think Lucid is going to build out their whole plant and build out the brand. And I'm not sure whether Saudi Arabia fund is going to buy them outright, but we know that Saudi Arabia wants to divest away from fossil fuel and more into EV. So this goes along with their strategy on expanding into the EV market. So I think the probability of expanding further is huge.
Yeah, Jamie, where do you think Lucid stacks up here in terms of competition? Obviously, the number of vehicles that they produce deliver a fraction of what some of its competitors are doing. How are they going to compete given that disadvantage that they're at? And then also the fact that they're offering their own price cuts, their own $7,500 credit for just a couple of vehicles.
Right. Remember, the Lucid cars are premium vehicles, so they start about 72,000, could head up to 150. So it's a different market from Tesla, where it's more consumer driven. This is more for the luxury buyers. So there's probably not a large EV buyer for the luxury market, but the company is trying to go to a more affordable range. So I think that's pretty much the strategy. Now, I think the downfall is we should hear a little bit more about their go-to market strategy as far as advertising and getting the vehicle out to the public.
What's your biggest outstanding question for the call, and do you expect that your price target will remain?
Yeah, I think the price target will remain. Like I said, I want to see hear about a little bit more of their go-to market strategy. They've been opening up studios, not really advertising. They want to get their cars out, sort of create an ambiance. And once the product is out, I think we should see a little bit of ramp up in demand. But also remember, they gave $7,500 tax credit for certain models, which should help out in the first quarter and with revenues. But let's see if that continues going forward.
All right, stock off just over 8% here in extended trading. Jamie Perez, thanks so much.
All right, thank you.
Coming up, we are waiting NVIDIA's earnings. We'll bring that to you as soon as they're released. We'll be right back.
Is the 4-day work week the answer to America's burnout? Can less actually be more when it comes to time spent at the office? The world's biggest study of the 4-day work week suggests the answer to both those questions is yes. Employers saw productivity, for the most part, increase, as did employees' mental health. Joining us now is Juliet Shore, a Boston College economist, and sociologist. Her team led this study of 61 British businesses and 2,900 employees. So Juliet, great to have you. 90% will continue studying it, 30% making it permanent. Why?
Well, they've had really great results for both the workers and the companies themselves. On the employee side, pretty much all the metrics that we looked at, stress, burnout, physical health, mental health, fatigue, exercise, sleep problems, satisfaction, all went up significantly. And at the same time, the companies experienced good revenue performance, reductions in absenteeism, better retention of employees, and they rated the trial an 8.5 on a scale of 0 to 0. So win-win for both sides.
You mentioned that retention. How much better did those companies perform? Because we know the labor shortage, at least here in the U.S., obviously a massive issue and something that many executives are pretty worried about.
Well, I see you have it up on the graphic, but the turnover fell by 57%. And in the UK, they're facing something similar, people leaving and a lot of open positions. One of the things we're seeing with this research is that more companies are coming to us because of those open positions, inability to keep people. And this is a real competitive advantage in the labor market.
Now, did the employees still work a 40-hour week? Did they go 4 10-hour days, or were they actually working fewer hours? And perhaps the question is, why not do this in terms of the employer side of it?
So it's not a 40-hour week. It's for most of the companies, they went to a 32-hour week, 4 days. On average, not everybody got down there because occasionally people would have to do a little bit of extra work or maybe an hour of work on their off day. But the new schedule was for almost all of them was for that 4 days, 32 hours. You said, why not? Well, we think that the results from this trial, the 2 previous trials we did, the trials that we are just finishing now, show that for many companies, this really is a viable option, that employees are much better off, they value their jobs more, and they're able to maintain productivity through a kind of work reorganization process that they go through for 2 months before the trial starts, getting rid of a lot of dysfunctional cultures around meetings, distractions, and so forth. So I think partly we just need to spread the word that this is a viable way to work.
There must, though, be a downside, right? Not everyone is continuing. I know I'm skeptical, but there has to be some downside to shifting.
Well, partly, almost nobody is not continuing. Let me just say that. Yeah. In our first 2 trials, nobody told us they weren't continuing. I think maybe 1 or 2 out of the 61. Partly it's a self-selection bias, right? These are companies who opted to do this, presumably because they thought they could make it work, and almost all of them did make it work. This doesn't mean that any random company could suddenly succeed with this. There are some companies that are burning their workers out. They can't ask them to do 5 days work in 4 days. Healthcare comes to mind there. For those, you're going to have to hire new people on that 5th day. But if they don't do something about the way they're overworking and burning out their workers, there are big costs to that too. So I think ultimately this can be viable for all companies. It may just take us a while to get there.
Yeah, and this study, of course, took place in the UK. When you talk about it potentially happening over here in the US, do you see it working here? And why do you think maybe we have seen a resistance here in the US when it comes to a 4-day work week?
Well, we've already done and finished 1 trial in the US, which was a huge success, with very similar findings. We released those reports in December. It was about half the size of the UK. We started another one in October of 2022, and we're finishing that next month, and then we'll be starting another. So there are plenty of companies in the US that are beginning to do this and doing so successfully. And one interesting thing is, although most of these companies are white collar companies, professionals and tech and so forth, we have restaurants, healthcare, we have manufacturing, construction. So you are seeing companies across the board that are actually implementing this successfully.
Wanted to get your thoughts before we go on Amazon employees outright rejecting what Andy Jassy, their CEO, has said come back to the office 3 days a week. There are 15,000 on a Slack channel complaining about this, an internal petition. What do you make of that rejection of 3 days a week, given that they already laid off 18,000 workers? And where are we headed in terms of return to office? Are we going to plateau about that 50% mark?
I can't predict that, but I do know that the resistance that many workers have to going back into the office is also part of what is creating more pressure for a 4-day week, because people are burned out. They're stressed out. A 2-day weekend is not enough. And companies need to recognize that. People worked really hard through the pandemic, but it was extremely stressful. And it's not clear to me why some of these companies are taking such a hard line on getting people back into the office, when it's pretty clear a lot of people prefer at least a hybrid with only a couple of days on-prem, as they say.
Should be interesting to see how that wraps up and how your test goes here in the United States. So please come back once you've fully conducted that. Juliet Shore from Boston College, great to have you. Appreciate that. Coming up, we'll shine a light on some of the biggest after-hours movers, including Teladoc, one of the many companies reporting earnings this afternoon. That's after the break.
Check it out, everyone. After the call, coming at you. And guess what? The next company that we're going to be listening close to is NVIDIA. Julie, what are you going to be watching for?
I mean, they already are one of the original AI companies. You know they're going to talk about that buzzword somewhere along the way.
I'm going to be watching for those graphics processing units, the GPUs. Ladies and gents, boys and girls, tune in to After the Call. We break down all things NVIDIA.
All right, a very busy day in earnings. Let's bring in Jared Blickery now for a look at what's trending after hours. What are we seeing, my man?
Well, we got Cheesecake Factory, a little bit of a disappointment. You can see stock down about 3.5% in after hours trading. Now, revenue for the fourth quarter coming in light, $892.8 million when the street was looking for $901.9 million. Fourth quarter adjusted EPS, 56 cents. That is 3 cents lower than the street average of 59 cents. And then net income, adjusted net income coming in at $27.4 million versus estimates of $28.9. Now, one of the key metrics here is comparable sales. So that was actually up 7% in the fourth quarter. Estimates were for a little bit less than that. So that is a nice beat right there. Street looking for about 5%. Now here's a quote from David Overton. He's the chairman and CEO, saying, "Our fourth quarter performance was a solid finish to a challenging year marked by persistent inflation, volatility, and a dynamic operating environment." Going on to say, "Our best-in-class operators continued to do an excellent job of managing their restaurants, building sales, and delivering delicious, memorable experiences for our valued guests." Now, let me just show you a quick chart here. Here's year to date. You can see Cheesecake Factory up about 28%. Now I'm going to show you a 3-year chart so you can get the whole pandemic experience here. Really rallying into early 2021, may have been a meme stock at the time, and you can see really just about downhill ever since over the last 2 years, down about 24-25% there. Now we got to move on to Teladoc. That stock is off about 8% in after hours trading. Let me just pull up the numbers here. For the fourth quarter, a little bit light on, actually revenue was a beat. So that came in at $637.7 million. Street looking for about $4 million lower, $633.1 million. Adjusted EBITDA clocking in at $94.1 million, up 22% year over year. The estimate was for lower at $91.7 million. Here's another stat. This one came in light. Gross margin 68.6%. Estimate was for a little bit higher, 69.6%. Now, the guidance here, I think, is where there's some disappointment. Of course, that's what matters. Teladoc sees first quarter revenue $610 to $625 million. The estimate was for higher, $652 million. When you're talking about the full year, they're seeing 2023 revenue of $2.55 to $2.68 billion. Estimate was for higher at $2.72 billion, and they're seeing 2023 adjusted EBITDA $275 to $325 million. The estimate was for $292.4 million, so kind of right in the middle there. I'm going to call that in line. And I do have a quote here. "Based on what we know today, we believe our outlook ranges provide a reasonable baseline for 2023 financial performance. Despite a challenging macro environment, we were able to expand our product offerings and enhance a level of care delivered across our integrated whole person platform." And now let me just show you some charts on Teladoc. This is going to be over the last 2 years, down 90%. This was an early pandemic darling. People were phoning in for their doctor's appointments, and we can see what happens when you deflate those multiples. Even on a 3-year basis, down about 75%, guys.
And down another 8% here in extended trading rate. Jared Blickery, thanks so much. We'll be right back. We are still awaiting NVIDIA's earnings report. Shares closed the day, but still waiting on this. They should be out any minute. Julie, lots of focus on what we could potentially hear from NVIDIA. There's been some excitement since the start of the year. Stock off to a strong start. A lot of the excitement surrounding AI.
Well, first of all, let's acknowledge it is strange that the numbers are not out yet. It's due to begin its conference call at 5 p.m., 15 minutes from now. It's unusual that you wouldn't already have the numbers out. We were expecting them at around 420, then maybe...
Tell you something?
Not necessarily. It's tough to know. Maybe a higher up executive looked at the release last minute and said, I don't like that. I want to tweak the language. It's difficult to know. I don't want to sort of infer anything necessarily.
Perhaps an error that they were aware of at the last minute as well.
Could be that. But let's talk about the numbers. And indeed, AI is a big part of the picture for NVIDIA and has been, right? Even before this current wave of generative AI, right? This company has been in the AI business through its data center business, because in order to teach, quote unquote, AI, to train AI, you need big data centers. You need a lot of processing capability. And that's a lot of NVIDIA's business. Its data center business is the largest part of its sales. More than half of its sales in the last couple of quarters were accounted for by data center. AI would fall into that bucket. Then gaming is the next biggest slice. It's known as a big gaming company. Automotive growing quickly. It's an area that the company's really been emphasizing, but it's still a very small piece of the company overall.
On gaming, we expect a beatdown. It is not a good environment, but on the flip side, they have this 10-year deal with Microsoft moving. But that's more a moving forward story. Looking back on the quarter, probably tough gaming numbers as well as PC weakness. Is that the two numbers that will really reflect not a tremendous?
Right. I don't think of NVIDIA as synonymous with PCs as I do other chip makers like an Intel, for example, because it is a graphics processing chip maker primarily, not so much a PC.
But the gaming you expect to be a drag.
There's part of it. Yes, the gaming is likely going to be a drag. Overall, revenue is expected to fall 21%. That's the second straight quarter of declines for NVIDIA that analysts are targeting. The gaming revenue estimate around $1.6 billion. Data center revenue estimate around $3.9 billion or so. So those are the numbers we're looking for. But in terms of gaming, it's like anything that got a big boost during the pandemic. Like you guys were all sitting at home. Some of that is gaming. You know, if you're a big gamer, you bought a nice new rig for yourself during the pandemic. Maybe you got a nice new gaming chair. You got the whole thing. You don't need to get that again at this point.
These kids were playing Fortnite for 6 hours a day. They haven't played it in years. I'm talking about all my kids. Can I ask you real quickly, you mentioned Intel. How surprised were you by the dividend cut, 2/3 lowest since 2007? And what does it say about them just losing their leadership position?
I mean, it's been a process, right? So it wasn't that shocking to see that dividend cut, even though the company had made noises about trying to hold on to that dividend. It was looking unlikely. I mean, when you're targeting a $3 billion cut to costs this year and an $8 to $10 billion cost cutting over the next several years, right? At the same time that you're trying to build out new fabrication facilities in the United States, like, you need, that cash is going to need to come from somewhere. Something's got to give. We've talked a lot about how Intel has lost market share to AMD. So there's the double whammy of losing market share and then PC sales being weak, and that has really hurt Intel. But as you look across the chip universe, the growth just hasn't come from an Intel, right? It's come from the newer players like an NVIDIA. It's come from an AMD. It's come from a Qualcomm as well. All of these companies trying to sort of race for some of the newer growth areas within semiconductors, like an AI, like an automotive, like an Internet of Things, right? Which we don't talk as much about now, but it's still a growth area for these guys. So, that's kind of the big picture chip landscape, and Intel is not playing in that area as much as
Right.
the others, but it's trying to sort of get back into what are seen as the growth
Long game of
areas.
catch-up for Pat Gelsinger.
Very long game, and the pressure is on
Unfortunately
Gelsinger.
so,
That is
yes.
for sure. All right, Julie, thanks so much for that preview. We've got more on the market action on the other side of the break. Some breaking news, NVIDIA out with its results. Julie Hyman has that for us. Hey, Julie.
Hey, well, I'm going to tell you the most important things first, and that is that the company's first quarter revenue estimate looks to be above what analysts have been estimating. So the company is saying first quarter revenue going to be $6.5 billion plus or minus 2%. Analysts have been forecasting $6.35 billion. So that seems to be really the thing initially here out of the gate that the market is keying in on. You can see the shares are rising 7% as we see a quick reaction here. If you look at the last quarter that the company is reporting, revenue falling as expected by about 21% to $6.05 billion. Earnings per share beating estimates by 7 cents at 88 cents a share. And the gross margin, important here, at 66.1%. The estimate was 65.8%. And that is a number that's going to be important for the market as well, as we have seen these sort of over-inventorying, supply gluts in the chip industry. The margins have been a number that people have been keying in on. Now let's talk about the different segments here. Data center revenue disappointing, coming in at $3.62 billion. The estimate was $3.86 billion. Remember, that's the biggest chunk of the company's revenue. Gaming revenue, though, beating estimates, $1.83 billion versus the $1.6 billion that analysts had been estimating. I remember we were talking about how does AI play into all of this? That really falls into the data center category, all of this data crunching that needs to be done in order to power AI. Jensen Huang, the founder and CEO of NVIDIA, talking about that in the statement, commenting AI is at an inflection point, setting up for broad adoption, reaching into every industry, he says. From startups to major enterprises, we are seeing accelerated interest in the versatility and capabilities of generative AI. And he says we are set to help customers take advantage of breakthroughs in generative AI and large language models. You know, it's interesting going into this report, you guys, I figured that the company would be talking about AI, at least on the call. He's leading with it. He's not wasting any time reminding investors we are here. We have been in this space for a while. So that's interesting. On the gaming front, he does comment gaming is recovering from the post-pandemic downturn, with gamers enthusiastically embracing the new Ada architecture GPUs with AI neural rendering. As usual, a lot of fun technical speak in the statement, which I know our Dan Halley is into, which I'm not as good at translating.
I was going to say, it's always very, very hard to understand some of those technical terms. All right, Julie, stick around because we want to talk a little bit more about these results that we just got from NVIDIA. We want to bring in Will Summerlin. He's ARK Invest co-lead of ARK Venture Analyst. It's great to have you here. So the strong guidance, one of the big reasons why we're seeing the reaction that we are. AI, how much of that is playing into it? And what do you make of these results?
Yeah, AI is really the driver for NVIDIA's future. And they've defined themselves as the market leader. If you look at AI compute and our expectations for AI compute over the next 5 to 10 years, we think this market's going to continue to expand. The trend is such that the larger you train a model, the more compute you use to train a model, the better the model performs. And so for the next 5 to 10 years, we think this market will only continue to expand. With that said, we think a lot of the upside in NVIDIA may be priced in. There's a lot of competition coming. AMD is now aggressively moving, AMD is now aggressively moving into the compute space. We saw what they did to Intel with CPU, and they're trying to do the same thing in AI with NVIDIA. And so there's compute coming there. We also see companies vertically integrating. And so Tesla, for example, is putting a lot of effort into Dojo, which is their own training computer. And so we think NVIDIA will continue to be the market leader for some time, but we do see more competition coming.
We've been told for months we've seen a tough environment in gaming. What do you make of the numbers there?
Yeah, it's interesting. For us, really, the future for NVIDIA is AI, and that's where we're spending the most time. We do actually think that AI, as it evolves and increases the productivity of knowledge workers, will give people more leisure time. And much of that leisure time could be spent on gaming and other forms of digital consumption. And so certainly part of our thesis, but we really think the future for NVIDIA is in AI.
You know, Will, it's Julie here. What's really funny is last year at this time, the future of NVIDIA was in the metaverse, right? Like, I remember the company was touting that. Not so much the metaverse we think of where you put the thing on and you're in the virtual office, but sort of B2B, building virtual worlds and training AI in those virtual worlds. You don't hear NVIDIA talk so much about that anymore, but is that still part of this whole AI picture?
It certainly is. And for us, AI has been the story all along. NVIDIA has seen applications for their GPUs across a variety of use cases in AI, from training large language models, like the ones that power ChatGPT, the popular tool that's come out from OpenAI, to simulation to help train self-driving cars. And so we've really looked at NVIDIA through this AI lens for the last couple of years. And the applications that we see around simulation are certainly part of that.
What is their significant advantage in the space, their competitive advantage? And I assume you're going to go in the AI direction. And if so, why are they said to be the primary beneficiary of ChatGPT?
It's really the software on top of their hardware that helps companies train large, complicated AI models. If you want to take a raw data set of text and train a model that performs like ChatGPT, it's very, very difficult to do. You need many PhDs, you need millions of dollars in compute, and NVIDIA has built software that really helps manage that training run. We actually just invested in a startup called Mosaic ML, which abstracts away a lot of that complexity. And so if you have a data set and you want to train your own version of ChatGPT, you can do it through Mosaic's platform. And they use a variety of what are called algorithmic efficiency techniques to make training cycles more efficient. And so now companies can take their own data sets and train their own version of ChatGPT for just a few $100,000. And so we see the software abstraction layer really helping companies embrace the power of AI And NVIDIA is really focused on that historically, and that's made their hardware perform better than the competition. But again, we're starting to see more companies vertically integrate. Tesla has decided it's worth building their own computers, right? They're building Dojo to train their own models. And with that vertical integration, they can optimize the computers down to the hardware level for the specific use case that they're pursuing. In their case, self-driving vehicles. We're also seeing other companies like Google build their own hardware. And again, AMD is woken up, right? The beast is awake, and they're certainly going after this market. And so they're continuing to invest aggressively and would not discount them, especially given what they did to Intel in the CPU market.
No question. You can see the shares up 7.5% after a solid Q4 earnings report. I know you got to run. Will Summerlin's going to go jump on that earnings call. Appreciate that analysis, sir. Be sure to stick around tonight, 6 o'clock Eastern Time, as Julie Hyman and Brad Smith will recap NVIDIA's earnings call and break down everything